Most people think the hardest part of investing is picking the right ETF. It's not. The real problem is that people don't understand what their money's gonna do while they're waiting. Because $500,000 can grow, pay, or sit there feeling useless depending on the ETF, even when the returns look good on paper. That's where expectations break. In this video, I'm taking $500,000 and running it through 5 very different ETFs over the same 5-year period. You'll see what each account looks like at the end of every year. I'll show you one ETF that ends up paying over $70,000 a year in dividend income, and another that can more than double that same $500,000 over those 5 years. And in the end, I'll show you a combined portfolio built from all 5 ETFs that could turn $500,000 into nearly $900,000 while still paying around $33,000 a year in dividends. To understand how we get there, we start with the ETF most people already expect to work, the Vanguard S&P 500 ETF, or VOO for short. VOO is usually the first ETF people think of, and for good reason. It tracks the S&P 500, which means it owns pieces of about 500 of the largest companies in the United States. The biggest companies matter more, so when names like Apple, Microsoft, or Amazon move, this ETF feels it. There's no clever strategy here. It's built to mirror the market, not outsmart it. The expense ratio is very low, which simply means more of your money stays invested instead of going to fees. This is the kind of ETF people buy when they want something simple they can hold on to for a long time. You're not betting on one company or one sector. You're spreading your money across the backbone of the U.S. economy and accepting that some years will be better than others. The trade-off is simple and long-term consistency. And the numbers behind VOO explain exactly why it behaves that way. The dividend yield sits at 1.11%, so income is never the main feature. Dividend growth has been steady at around 6.04%, but still modest in absolute dollar terms. Where VOO really does the heavy lifting is share price appreciation, which has averaged about 13.31%. Historically, most of the return comes from the value of the shares rising, not from cash being paid out. Here's what that means for $500,000 over the next 5 years. By the end of year 1, the account is projected to grow to $572,100. Year 2 pushes it to $654,135. In year 3, it reaches $747,444. Year 4 comes in at $853,544. By the end of year 5, the portfolio will be sitting at around $974,156. On paper, that's strong progress, nearly doubling over 5 years without chasing trends or trying to guess the right moment to buy or sell. The ride isn't always smooth, but the direction over time is clear. The income side, well, that tells a different story. In year 1, dividends come out to $5,550, which is about $463 per month. Year 2 rises slightly to $5,889. Year 3 moves to $6,244. Year 4 reaches $6,615. By year 5, dividends are $7,005 for the year, or roughly $584 a month. Nothing is broken here. This is exactly how a growth-first ETF works. Most of the return stays locked inside the account instead of showing up as spendable cash. If your goal is long-term growth, this makes sense. But if income is part of the expectation, this is where reality starts to feel different. Now let's see what happens when the same $500,000 is invested outside the U.S., where income starts to show up very differently. VXUS is designed to give you broad exposure to companies outside the United States. It holds thousands of stocks across developed and emerging markets, all wrapped into a single fund. Instead of focusing on one country or region, it spreads money across Europe, Asia, and other parts of the world. Like VOO, it's market-weighted, and like most Vanguard funds, the expense ratio is low, so costs don't eat into returns very much. The reason people add something like VXUS isn't to chase faster growth, it's about owning markets that move on different cycles and tend to pay more in dividends. That difference shows up pretty quickly when you look at the metrics. VXUS comes with a 2.96% dividend yield, which is almost 3 times higher than VOO. Dividend growth has averaged around 6.52%, so income tends to rise steadily over time. On the growth side, share price appreciation has been more modest, averaging about 6.49%. Less speed, more balance. Here's what that means for $500,000 over the next 5 years. With $500,000 invested, VXUS grows more slowly than VOO, but the path is steady. By the end of year 1, the account is at $547,509. Year 2 moves it to $599,536. In year 3, it reaches $656,512. Year 4 comes in at $718,909. And by the end of year 5, the portfolio is sitting at $787,242. Now, that ending number is noticeably lower than VOO, and that's usually where people stop the comparison. But VXUS tells a different story once you look at income. In the first year, dividends total $15,050, which works out to about $1,254 per month. In year 2, dividends climb to $16,485. Year 3 comes in at $18,056. Year 4 increases to $19,778. And by year 5, annual dividends reach $21,664, or roughly $1,805 a month. So VXUS trades speed for balance. The account doesn't climb as fast, but the income shows up earlier and grows steadily along the way. For some people, that makes it easier to stick with it during slower markets. But VXUS is still built around diversification first, not dividend growth as a primary goal. So next, let's look at what happens when you choose an ETF that's designed specifically to grow dividends over time without walking away from growth entirely. After that, I'll show you one ETF that pays over $70,000 a year in dividends, another that turns $500,000 into more than $1.2 million. And in the end, I'll show you a combined portfolio built from all 5 ETFs that grows $500,000 to nearly $900,000 while still paying around $33,000 a year in dividends. But first, let's move on to the third ETF on the list. After seeing how VOO focuses on growth and VXUS brings in diversification and higher income, SCHD sits right in the middle of those two ideas. SCHD is built around U.S. companies that pay dividends, but not just any dividends. It tracks an index that screens for quality and consistency. Companies need a history of paying dividends, the ability to sustain them, and the financial strength to keep growing them. Because of that, the fund holds a more concentrated group of about 100 companies instead of hundreds or thousands of companies. The expense ratio is still low, and the goal is simple: reliable income that grows over time. This is often where people start to feel more comfortable, because SCHD isn't chasing the highest yield and it isn't ignoring growth either. It's trying to do both reasonably well. The metrics explain that balance. SCHD's dividend yield sits around 3.51%, which is meaningfully higher than both VOO and VXUS, but lower than pure income funds. Dividend growth has averaged about 10.61%, which is where SCHD really stands out. On top of that, share price appreciation has averaged roughly 9.04%. Not explosive, but strong enough to matter. When growth and income are both doing real work, this is how $500,000 moves over the next 5 years. By the end of year 1, the portfolio is projected to be around $562,751. Year 2 moves it to $633,687. In year 3, it reaches $713,919. Year 4 comes in at $804,716. And by the end of year 5, the account is sitting at $907,525. That growth alone puts it ahead of VXUS, but the real difference shows up in the income. In year 1, SCHD pays $17,550 in dividends, which comes out to about $1,463 per month. In year 2, dividends rise to $20,063. Year 3 moves up to $22,946. Year 4 reaches $26,257. And by year 5, annual dividends are $30,061, or roughly $2,505 a month. At this point, the trade-off starts to feel clearer. The account is growing at a solid pace, and the income is becoming meaningful enough to notice without giving up growth completely. But SCHD is still trying to balance two goals at the same time. If income becomes the main priority and growth is allowed to take a back seat, the numbers start to look very different. And that's where the next ETF changes the experience completely. And for that, I have the JP Morgan Equity Premium Income ETF, or JEPI for short. JEPI is built differently from the ETFs we've looked at so far. Instead of just holding stocks and waiting for dividends, it uses a strategy designed to generate regular income. It holds large U.S. companies, but it also sells options on those holdings to bring in extra cash. The option income combined with dividends is what allows JEPI to pay much higher distributions. Because this strategy is more involved, the expense ratio is higher than something like VOO or SCHD. But the goal is clear: steady income. Because this approach is more active and more complex, the expense ratio sits around 0.35%, which is higher than something like VOO or SCHD. But JEPI isn't trying to be cheap or elegant, it's trying to pay. This ETF tends to attract people who care less about seeing the account value climb quickly and more about how much cash shows up month to month, and that difference shows up immediately in the numbers. JEPI's dividend yield sits around 8.06%, which puts it in a completely different category from the other ETFs so far. Dividend growth has averaged about 7.88%, meaning income tends to rise quickly once it gets started. On the growth side, share price appreciation has been much lower, averaging around 2.64%. The priority here is obvious. So when income is the priority, this is how $500,000 actually moves over 5 years. By the end of year 1, the portfolio is projected to be at $553,490. Year 2 moves it to $615,041. In year 3, it reaches $686,172. Year 4 comes in at $768,740. By the end of year 5, the account sits at $865,030. That growth is noticeably slower than VOO and SCHD, but that's not why people own JEPI. In the first year, JEPI pays $40,300 in dividends, which works out to about $3,358 a month. In year 2, dividends rise to $46,950. Year 3 increases to $54,906. Year 4 pushes it to $64,467. And by year 5, annual dividends are $76,010, or roughly $6,334 a month. JEPI makes one thing crystal clear: if your priority is cash flow, this kind of strategy delivers. But once you lean this far into income, you're making a conscious decision to give up some long-term upside, and that naturally leads to the opposite question. What happens if you stop worrying about income altogether and let growth take complete control. For this, I have the Vanguard Information Technology Index Fund ETF, or VGT for short. VGT focuses entirely on U.S. technology companies. It tracks an index made up of firms in software, hardware, semiconductors, and other parts of the tech ecosystem. Because it's market-weighted, the fund is essentially all tech at 99.58%, which means a handful of names can drive a lot of the performance. The expense ratio is low, but the real cost here isn't fees, it's concentration. When tech does well, this ETF can move fast, but when tech struggles, you feel it. People who choose something like VGT are usually comfortable with that trade. They're not looking for income. They're betting that innovation, productivity, and scale will keep pushing these companies higher over time. The metrics make that focus obvious. VGT's dividend yield sits around 0.41%, which is almost negligible. Dividend growth averages about 1.76%, but from a very small base. Where VGT truly dominates is share price appreciation. Over the past 10 years, the chart shows gains of over 670%, which works out to an average of roughly 20.41% per year. And over this 5-year window, that bet pays off in a big way. Starting with $500,000, the account will grow to $604,050 by the end of year 1. Year 2 pushes it to $729,302. In year 3, it reaches $880,083. Year 4 comes in at $1,061,604. And by the end of year 5, the portfolio is sitting at $1,280,137. That growth is larger than anything we've looked at so far. On paper, it's the clear standout, but the income side barely exists. In year 1, dividends total $2,000. Year 2 slips slightly to $1,966. Year 3 comes in at $1,931. Year 4 drops to $1,895. And by year 5, dividends are at $1,860 for the year. Even at the end of 5 years, that works out to roughly $155 per month. It doesn't grow, it doesn't keep pace with inflation, it's essentially irrelevant to the overall experience. Even though the account value is much higher by this point, the income doesn't rise with it. If dividends were growing at the same pace as the balance, you'd expect the income to increase, but with VGT, growth overwhelms dividends. Tech companies reinvest profits instead of raising payouts, and as share prices climb much faster than dividends, the yield keeps shrinking. So the base gets bigger, but the income doesn't scale with it. After seeing how growth, income, balance, and diversification behave on their own, the focus shifts. It's no longer about which ETF wins, it's about whether any single approach actually makes sense by itself. Each ETF does something well, and each one comes with a trade-off that becomes harder to ignore the longer you hold it. So instead of leaning all the way into one idea, this portfolio spreads the job across all 5. Here's how the $500,000 is allocated for a portfolio of all 5 ETFs. 30% goes into JEPI, or about $150,000, to anchor income. 30% goes into SCHD, another $150,000 to grow that income over time. 20% goes into VXUS, roughly $100,000 to add diversification and higher international dividends. 10% goes into VOO, about $50,000 to keep steady U.S. market growth in the mix. And the final 10% goes into VGT, another $50,000 to give the portfolio a dedicated growth engine. With this portfolio, no single ETF is carrying the entire plan. Each one has a role. When you step back and look at the portfolio as a whole, the metrics reflect that balance. The combined dividend yield comes out to about 4.23%, which is high enough to matter without forcing income at the expense of growth. Dividend growth averages about 7.63%, so income doesn't stay flat as time goes on. And share price appreciation averages roughly 8.17%, keeping the portfolio moving forward even when income isn't the focus. That combination sets expectations. This isn't a portfolio that tries to win in one category. It's built to work across different conditions. Here's what that structure does to $500,000 over the next 5 years. Starting with the same $500,000, the combined portfolio grows to $561,994 by the end of year 1. Year 2 pushes it to $631,546. In year 3, it reaches $709,561. Year 4 comes in at $797,052, and by the end of year 5, the portfolio is sitting at $895,152. That ending number doesn't beat VGT. It doesn't beat VOO either, and that's intentional. The goal isn't to rely on one thing going perfectly. The income fills in the rest of the picture. In year 1, the portfolio generates $21,125 in dividends, which works out to about $1,760 per month. In year 2, income rises to $23,615. Year 3 moves up to $26,394. Year 4 reaches $29,493. And by year 5, annual dividends are $32,950, or roughly $2,746 a month. The portfolio is still growing, but it's also paying you in a way that feels real and consistent. You're not waiting years to feel progress, and you're not giving up growth just to get paid. It's not perfect. It won't win every comparison, but it smooths out the extremes. Growth doesn't feel volatile. Income